November is as billed, another lousy month, and really not a great quarter either, Derek. But this is something that we talked about. You called it seasonality last time we spoke.
Right. I mean, we saw small caps down roughly 5.5% for the quarter, the S&P down a little over 3%, and the NASDAQ down 5%. And essentially, the seasonality progression has played out for the most part this year. And the good news is seasonality would suggest the fourth quarter with an S&P 500 up more than 10% for the year is leaning to the positive side. And we'll see how that goes, particularly as we approach earnings season.
Yeah, that's right. Earnings season coming up. But before we get to that, we got what's called a PCE number, and that is the preferred indicator by the Fed for inflation. It's a number that they actually liked.
Right. It was below 4% on a year-on-year basis for the first time in 2 years. The Fed continues to be hawkish about what their expectations are for interest rates. But again, they continue to talk about being data dependent. And with this potential government shutdown, one of the things that could happen is they won't have the data that they normally would have, which some people believe would reduce the likelihood of a November rate hike.
Yeah, and you talk about, really all the things that they have to look at. And of course, they look at inflation. That is an indicator. And then you mentioned two pieces of information here. Number one is a potential government shutdown, and that news is continuing to come in as we speak. And of course, the UAW tells us, at least through the Wall Street Journal, that they're going to step up their strikes. Both of those things could slow down the economy.
Absolutely. So, we really have a mixed bag going forward. And I think, the fourth quarter is really going to be all about interest rates and inflation because as David Tepper, a noted hedge fund manager, said today, the competition for equities is pretty severe. He bought a 6-month CD that yielded over 6%. He talked about the transition from an environment of quantitative easing to quantitative tightening and what the impact is on earnings multiples. So it's going to be a touch and go at the beginning of the month, and it's typically October can be volatile. So we are prepared to add duration and equity exposure at the right time.
So let's put a little light on what David Tepper was saying, the move from quantitative easing to quantitative tightening. That sounds like a lot of economic mumble jumble, but really what it means is the fact that for almost 14 years, the federal government, especially the Federal Reserve, was keeping interest rates abnormally low. That's quantitative easing. And now they've taken that governor away, if you will, and interest rates have risen dramatically up to 5.5% in a short amount of time. So what that does is it puts pressure on equity prices and bond prices.
Right, and it has the most impact on faster growing companies and companies that make no money, because essentially the ones that make no money are forced to refinance at higher rates, which is why we watch the default ratios so closely. Beyond that point, the valuations of the S&P 500, most of the stocks, the 493 that essentially have done little to nothing this year, are trading at about 15 times. But when you add in the big seven, that number jumps all the way up to 19 times. So either the multiples on those big stocks have to come in or the multiples on the smaller stocks have to expand.
Now, let's talk about one more thing, the government shutdown, potential government shutdown. And, the market seems to be taking that in stride, which is a bit surprising because of all the consternation that you read in the newspapers.
Well, in the past, these shutdowns haven't really had any prolonged impact on equity prices. And ultimately, some could take the glasses half full approach and said any agreement will be a positive and reduce uncertainty. And typically in the fourth quarter, there is a pronounced bias to the upside, particularly in years in which the markets are up going into that. So we're going to watch earnings seasons because right now, for the first time in a couple of quarters, we're expecting to see earnings growth about 2%. But if you X out energy, which actually is showing negative year-on-year comparisons, the number's closer to 7%. So a much better forecast than what we saw in the last couple of quarters.